Let me very briefly introduce each one of you, and of course I'll leave the floor to our dear moderator to say more. I'll try to guess now. I think I'll recognize you. I just checked at least 10 times to make sure I don't make a mistake. So let me just briefly start with you, Achim. Grobosch, you are from R&V Versicherung. I'll move now to your left. Your left is Frederic G. Nadal. You are from MV Credit Partners LLP. I'll move now to you in the middle with Ellie Appelbaum from Eris. And last but not least, Darren Thomas from Pimco. And our dear moderator, Emmanuel Issanchou, Deputy Head Global Markets, Head of Global Markets Americas, and also Head of Global Credit Markets from Natixis CIB. The floor is yours to introduce the panel and obviously our dear speakers. Thank you.
Thank you, Christina. Thank you very much. Yes, a lot of hats, cost-cutting, in Natixis, so you need to have a lot of jobs, and I'm just kidding. Thank you very much. Good afternoon, everyone. Very happy to be here. Actually, this is our second edition. Last year, we did that in June. First panel on alternative credit last year. Definitely a different environment. We were starting already to discuss, alternative credit through the prism of changing paradigm, interest rate, inflation, geopolitical tensions, of course, and what this area would morph into or would develop in a different, I would say, dynamics on fundamentals, on technicals, and fast forward 18 months after that now, clearly a lot happened. The rate cycle didn't fade, clearly not. Rates at a very high point. We have as well, and I'm kind of not surprised, but we had two, I would say, events in the market, at least two that I can remember of over the last few months. The Credit Suisse situation, we had the regional situation, and we didn't still discuss that. Of course, it was the first effect of rates, mostly ALM driven. For Credit Suisse, it was a more complex situation. But I guess my point to follow up on the introduction, what I would like you to do, and by the way, I'm getting as well confused on the definition of private credit, alternative credit. There's a lot here. It can be anything to anyone. It all depends on strategy, how you guys think about it. So I guess as a follow-up introduction, maybe if you can give us a few minutes on the way you see alternative credit in your respective areas. Maybe starting with you, Darren.
So I'm Darren Thomas, portfolio manager at Pimco. Look after all of the financing that we do for our private funds. That's across all different sorts of asset classes, everything from commercial mortgages, resi mortgages, corporate bonds, and then kind of special situations, things like aviation, consumer loans, life settlements, et cetera. So, and the way we think about corporate credit, and I think it's pretty obvious based on what I just said, is we definitely think about it as a broader asset class than just the direct lending, private credit that I think a lot of people kind of frame it with. We view it as differentiating in people's portfolios, particularly portfolios like an insurance company, for instance, that might be heavily weighted towards traditional corporate credit. We think that it's a attractive market right now for a lot of these assets, and a lot of that reason is because of what Emmanuel said before, the Credit Suisse situation, right? The regional bank failures, the Fed hikes has significantly reduced supply in these markets and really opened up the path for non-bank actors like ourselves to come in and participate in these asset classes. And the way that we think about it is we're pretty indifferent in terms of where we're participating up and down the capital structure. We have capital that we can put to work at the junior or mezzanine slice of these types of assets, and we have capital we can put to work at the senior. So it really just becomes a relative value play in each of those different types of investments as to what part of that capital structure we want to play in.
Thank you, Darren. Eli?
Hello. The theme's pretty great, huh? So my name's Eli Appelbaum. I am partner and head of Europe for alternative credit at Ares. The way I would describe our business is essentially we are the opportunistic credit business at Ares. Everything we do is quite asset focused, so the way we think about alternative credit is separate from corporate credit, although we provide financing to corporates as well. So it's all underpinned by loans, leases, receivables, portfolios of contractual cash flows, and likewise we invest across the return spectrum, anywhere from investment grade on behalf of insurance companies, including our own captive insurance company called Aspida. We're not very creative in the finance universe with the naming. It's all very Greek themed, you might have noticed, as well as our private commingled funds on behalf of other investors. I feel like I've been waiting for this kind of market dynamic for about 15 years. So there's many, many years of watching people make, kind of suboptimal investment decisions and get consistently rewarded for it. When you have someone who's convinced they've learned how roulette works and they consistently bet on black and they win 3 or 4 times in a row and they're certain that they're right. So we're starting to see some real dislocation in the credit markets. And a brief reminder, if you haven't caught from the previous presentation, asset-backed markets are actually materially larger than traditional corporate leveraged finance markets. So as we see the dislocation in that space, we think that the growth of the provision of private capital in the asset-based context is actually much earlier in its stage of development compared to where the corporate environment is. So if you think that the provision of private credits to corporates is materially advanced, and I would argue there's a long way to go in that space as well, in the asset-backed universe, we're still very, very early innings in the growth of that space.
Thank you, Eli. Frederic?
So I'm Frederic Nadal, CEO and co-founder of MV Credits. That we used to have AIG as a shareholder, as a co-shareholder, 23 years ago when we started. We started with subordinated debt at the time in Europe, where we were probably 2 or 3 people doing just that. So we've seen the evolution of the private market over the last 23 years been dramatic, including the downfall of our co-shareholder AIG. So we've seen it all. Today we are exclusively focused on corporate credits, and we do everything around corporate credit. And I think the 2 themes, we do subordinated funds, senior funds, direct lending, semi-liquid credit funds, but everything we do, absolutely everything we do, is actually extremely easy, which is to lend money to company to get it back. And I think our only job is to not to lose money. So our job is quite it's quite simple, and it's just about that. And I think we've seen a lot of sophistication in the market, especially pre-08, unfortunately. And I think this is a wonderful time. This is the second time in my career it happens that it's a moment where you can very simply look back at what happened over the last 4 years with COVID, with what's happening in Russia and Ukraine, with the inflationary environment, and look back how, as simple as that, how companies have been performing, how management have been handling companies, how management has been able to sail through all those times. And I think because we're so obsessed about losses, this is the way to look and to properly due diligence company. And it's the first time since 2010. So I think it's a wonderful moment for us, not to create the extra, I don't know why 25 bips, why 50 bips above. It's to return, consistent return over many cycles. So we're not focusing on 50 bips more than the market, 75 bips, 3%, this and that. We are focusing about minimizing losses. And that's everything we do right now. And I think for the reason I explained before, it's a wonderful time to do it.
Thank you, Frederic. Achim?
I'm Achim Grobosch. I'm from R&B Insurance Group, and I'm a senior portfolio manager in alternative debt investment group. We are focusing on private debt coming from a phase where we did those transactions on a very private basis. So the capital market wasn't functioning so well when we started private placement and really asked issuers to provide us with products exactly being on the capital curve we were looking after and not being provided in the public market. And so far, we started doing that on our own a bit, and then started doing private debt as well with partners, always looking to have a grip on the transactions. So not doing funds, of course, we established funds to do so, but we went and had a look at each and every transaction, and I think that is still key and echoes what you said, that it's crucial to have that due diligence, and now that we can see how companies have performed over the last 4 years in that very special situations.
Thank you very much. Maybe I just a follow-up question on that is, you say it's a, I would say, and I read that, you know, in Bloomberg, golden era for private credit. I mean, we've seen that as well for the last 10 years. Rates were low, illiquidity premia. For sure, it makes a lot of sense. And now, if I look at the manufacturing of credit on the primary, the banks, central banks, I mean, wants the world to deleverage. So by design, the way I see it is that we'll have less volume of primary assets. So does that mean that the golden era for private credit, knowing that the capital raised, it's every day you see still a lot of capital raised on that strategy, what does that mean? You know, that it means that effectively banks will keep losing effectively market share on the primary side? Does that mean that effectively you are going to move more into as well a secondary buyer of assets from banks? Because obviously there are, you know, quantum and volumes effect here. So more than happy to hear your thoughts are, and maybe starting with you, Eli.
Yeah, I think I'm certainly not a believer that it's the peak of the market in terms of volume for private credit issuance. I think we're also facing, I would argue, a generational transfer of value from equity to credit. So, and I have two ways to illustrate that. So one is think of like a typical company, and let's say they generate $100 million of free cash flow. There may be, on a leverage ratio basis, quite reasonably levered, and that used to capture 50-60% million of that cash flow for debt service, and now it captures 90. So what does that mean? Well, they'll still need to continue to buy leverage in the market for the foreseeable future as long as the business is a good one. Maybe the equity loses its money, maybe it doesn't. Let's see what happens to rates. Let's see how the business performs. But overall, I'm not speaking for our own book because I'm separate from the private corporate credit business. I'm not worried about that sub-asset class in terms of losses. You know, kind of some managers will do better than others. If you were taking losses in 2020, heaven help you, you're probably going to be in trouble. But if you are, you know, a top-tier performer, I think generally speaking, it'll be all right. But and you can look at North America versus Europe, the amount of capital that's provided by non-bank lenders as a proportion of the economy is just materially greater. Now, there is an irreplaceable component of both products and solutions and relationships that banks provide that's never going to be replaced. So I would say, you know, 7 out of 10 times we're in some way interacting or partnering with a bank, even when we're providing a lot of the corporate credit risk. But the demand for credit, I don't think, is going away. Maybe there'll be less leverage or more leverage, but the overall volume of production of private credit, I'd say this is a, you know, we're in the, use an American, you know, fifth inning out of 9, something like that, halfway through. Does that work?
Darren, can you add on that or elaborate on that?
Yeah, look, I would definitely concur that the usage of banks in this market is not going to go away, right? I think you can continue to see private credit grow and private credit funds continue to grow, but banks still play a useful role of origination, right? Advice to clients and sourcing for private credit funds. I think the business shifts a little bit from being a storage business, if you will, to a moving business and syndicating more things out. And we've already been seeing that, right, over the last couple of years, and that's not just a function of private credit pushing in banks that direction. I think it's also the different capital regimes that we've seen come into play that make some of these types of assets less attractive for the banking sector, right, and naturally moves it to buyers like insurance companies. And we've also seen, I think, borrower desire, right, that for longer maturity type financings, right, fixed rate financings, and that is stuff that just naturally fits insurance companies better than it does banks. So I think we'll continue to see that. I think that there's a natural symbiotic relationship between the banks and the private credit funds. You know, I know when I was at a bank years ago, we definitely saw it this way, though, that this was a massive threat to our business and like this should be shut down. But I think all the banks at this point have adapted and recognized that, you know, private credit is important to the market and have kind of modified their business models a little bit to reflect that.
So I just want to add very quickly, apologies, thank you.
Sure.
What's actually harder to get in a high rates environment? And I would argue it's equity. Because right now, when you, let's say you are an owner of long-term contractual cash flows and you think your valuation was 30 times EBITDA, let's say you're an infrastructure business or something like that, or a tower co, and you were borrowing at 3%, you're gonna have a tougher time raising equity today than you are raising debt. So the provision of maybe not exactly super senior secured AAA rated tranches, but subordinated debt and hybrid solutions, that is incredibly necessary in an environment where valuations are fundamentally shifting.
Thank you. Frederic, can you see, I would say, the relationship you have specifically in Europe with banks, and how do you see that evolving as well? Because you, as you said, you play across the capital structure, and then I think you rely a lot on the origination from the banks, and how do you see that evolving as well?
I think it's been mentioned several times before. I think there's enough, first of all, there's enough space for all of us. That's the first thing. So we're not going to fight for market shares in this market, which is going to keep on growing. Second point is, I think what's happening right now, as happened before, again, it makes me think about, for different reasons, what happened in 2010, 2011, where banks were shut down completely, and some very, there was much less liquidity than nowadays, and still people re-entered very, there was touch and go for valuations, for how do we do that, etc., etc. So it's not unusual to see this gray period where a kind of a, I will not say new model, but renewed model would emerge. And one of the things I see is definitely more collaborations between banks and private lenders, private creditors. We've seen that's been few announcement in the press over the last couple of weeks with banks, and I see that. I think the collaboration is going to be slightly different than the typical BSL model that the bank have been living on for decades. So there's a need to reinvent yourself. It's not going to be completely new, but there's definitely the banks are still, they still have a lot of things to sell to their clients, and many ways to help us to do deals. We want good assets. You want good clients.
We do a lot with you guys. I mean, so I'm very happy to hear that, and we're still here to continue the journey as the credit market keep evolving. I guess I will want to go to the liquid versus illiquid part of I would say the equation. And clearly, I mean, there is one. I remember one sentence which was a pro on the Patrick Artus the first panel, which was like illiquidity brings stability. I will be a bit provocative here. I strongly disagree myself. I love Patrick, but I strongly disagree on that, because as a matter of fact, illiquidity, when you think about it 10 years, like you don't have any issue, credit is benign, everything goes well, you don't see the valuation, so everything is good, you get, by the way, you recycle the capital, you get the coupon, it's all good. As investor, and I think Achim, for you, this question, I mean, how do you see illiquidity in this current market where, and we talked about, by the way, reporting, we talked about transparency, where credit issues can arise, we need to be timely about it in terms of working out some loans, working out some security, what it means in terms of valuation, what it means in terms of selling the loans. Is there an infrastructure market? It has been talked in the US about like a market making of private debt. We are not there yet, but I think there is like now, for now, and by the way, because of the balance sheet constraint we have in you know, so be it can be in insurance companies, can be in banks specifically, there are some needs of liquidity at some point potentially. So how do you see liquidity in this current market backdrop, which was not that big of a thing for the last 10 years?
Well, that's no secret that we are a hold to maturity investor, and so far illiquidity is not per se a bad thing. Of course, we have to have a look at the relative attractiveness, and when we had have a look at some years ago, there was no other chance than to go into illiquid products, because the liquid products were just not attractive enough. So we really then got that illiquidity premium, which was mentioned already before in other panels, and that helped us, of course, to get the yield that we were looking for. Having said that, And being now in a situation where liquidity, even for insurance companies, which we had plenty of in former times, now is becoming more and more a point to think of. Liquidity, of course, is getting more attractive, in particular as the liquidity premium is not that much anymore the decisive point, because we receive such a good yield with the typical government products, government bonds and Solvency II friendly products, that going into liquidity is not anymore a thing that we have to do, but it's one alternative we have to, and therefore we balance that in our decision making, and but it's not that that we had for liquidity these days, and liquidity products becoming more and more attractive with that high yield.
Yeah. So you touch upon relative value in some ways, and clearly, I mean, we've seen as well where the rates are going, and the most, I would say, secured part of the fixed income market. I mean, you can have even like right now for retail, like a cash deposit, daily liquidity, at 4 to 5%. So I guess the question is the liquidity premium real? Is it still? I mean, and when we see this capital raising, for the LPs, is the relative value relative to public market still very much at play? I guess, Darren, for you.
Yeah, I mean, we're still seeing significant illiquidity or structural premium, whatever you want to call it, in the market. We're able, in investments we're seeing right now, capture significant spread pickup over standard investment grade credit products out there, liquid investment grade credit products. I totally agree with you, by the way, that liquidity in and of itself should never be a bad thing, right? All else equal, liquidity is always a good thing. So the idea that somehow illiquidity is safer seems a little silly to me. I think that there's investors that should capture that illiquidity premium, maybe should allocate more of their portfolio to illiquids because that illiquidity premium does exist, pension funds, insurance companies. But I do think that liquidity should always be viewed positively for investments, all else equal.
Eli, any addition on this point?
Yeah, I think we've sort of overcomplicated this issue a little bit because we were all a little bit used to an environment, decade plus, extremely benign environment. So, assets and liabilities should generally kind of match, and liquidity is a component of relative value. I think people kind of forgot both of those things. Now, specifically about liquidity, I mean, ask people that were trying to sell high-grade bonds during the UK sovereign debt crisis a few months ago. It's not a lot of liquidity all of a sudden when you really need it. So the question is, how much of a liquidity is really available when the market is truly dislocated? But it's all a component of relative value. And I think when we are looking at our business, so we invest anywhere from investment grade on behalf of insurance companies all the way through the high teens and everywhere in between. And in a high rate environment, debt captures more value. Therefore, we have been able to improve the quality of the things that we're financing and or buying. So why would I give you an example? Why would I buy a portfolio and make 15% when I can finance that portfolio to make 12? Now, before the rates were higher, that same portfolio would have been financed at 6. So most of the opportunities for financing are relative value benchmarked, and if they're not floating rate, which most of our positions are floating rate, they are still priced on the basis of the interest rate curve. So that is, however, not an argument against liquids. I think liquids are also good value, right? And I think it makes sense that they're kind of back in vogue.
It's a great point, though, about measuring how much illiquidity you're actually giving up, right? If you're doing a, bilateral warehouse to a middle market manager, right? How much more liquid is that position really than a middle market CLO, right? In the times where you really need liquidity, trying to sell a middle market CLO is not exactly the easiest thing in the world.
Yeah, and actually, Frederic, you have like a liquid and illiquid strategy as well. You using CLOs that maybe you'll launch that. What's your view and what your investors say about these very points?
That's exactly the point. It's what the investors want. We're not even trying to figure it out whether this one is better than the other one, whether there's a real premium for illiquid ones. We hope there's one. We think there's one that varies, and changes across cycles. In the end, I think it really depends on what your investors want, who they are, and whether they need it. If you access the retail market, and some other type of investors, and you got 10 years fund, it's unlikely for many reasons, which are not linked with the premium, that they're going to like those funds. So it's more a matter of what you want to do with those investments than anything else. At least that's what we see with our investors.
Thank you very much. And to stay a little bit on that, but like on secondaries, and we've discussed that. And maybe one question for you, Eli. I know that I think it's been announced with you as well. The credit secondaries and the PE secondaries that you've launched those funds. Obviously, PE secondaries been in the market for some time now. Credit secondaries start to emerge. How do you see the strategy going forward? Clearly, there'll be need of rebalancing portfolio at the LP level, so this is a theme that we see emerging. How do you see this, I would say, this market developing? How the financing of the strategy will evolve? I mean, we do, a lot of fund financing ourselves, mostly, on the NAV, on the PSF, on credit asset. On this strategy, something we are looking at, but very hard to make our head around it in terms of pricing, in terms of leverage. It's hard. So how do you see the business from your standpoint?
Sure. So I think two separate opportunities. One is, and this is the part where we're spending most of our time, is providing solutions to GPs as well as actually LPs, pension funds, and to help them create leverage against these portfolios. And the reason why that's at an inflection point, I would say, is because, again, today, if you're an owner of long-term contractual cash flows, let's say you're a GP, and let's say you manage private equity assets, and you got a dozen companies in your portfolio, chances are your marks are flat, or maybe they're down 3% from last year. And chances are, if you were to trade your secondary LP stake, it's probably trading at 70, 80 cents, depending on how well your portfolio is looking. Those two things are unlikely to be true at the same time, right? If you're a REIT, and say you're not a traded REIT, your bonds probably have an implied mark because of where they're trading that's well below your book. If you're a traded REIT, you're probably trading well below your book. And I can go on and on for infrastructure and other assets. So if you're an owner of these assets in a high rate environment, the equity valuation of these assets is what's changing. Nobody wants to go through an equity valuation process in that kind of moment. So why would you sell your private equity positions today? It's one of the worst times to sell over the past 10 years. Capital markets are dislocated, rates are high, valuations are uncertain, so on and so on. So what do? Well, you can borrow against this portfolio, you can create a pref and so on. So these kind of hybrid solutions against these portfolios are very interesting, and we think they're at a growing inflection point. So that market has gone from somewhere where, speaking on behalf of Ares, we weren't paying much attention to it 3 years ago, and over the past 3 years, I think it's the only idea in alternative credit that's growing faster than our AUM. So very, very interesting space. The second point is what's happening to the private credit universe in general as it matures. Is there a requirement, is there a benefit to investors in that space to create liquidity? And if you look at the PE space, once the PE market gets a certain degree of maturity, people want to be able to adjust their portfolios and trade those stakes. Now that's fairly established as a market now, and I would argue credit has just reached the point where it's mature enough to have a real credit secondaries market. So it's public information. Ares has acquired a business called Landmark, which is a secondary specialist, and we would say the originator of that secondaries platform idea, and we think that's a growth opportunity for us.
Thank you very much. And maybe the same question for you, Darren, on that. Obviously, you use financing, you're looking at secondaries as well, you buying as well, actually, financing. So it's all I would say, aspect of the transaction. How do you see this market developing? Because it's a big thing going on, right? So.
Yeah, no, it absolutely is. And if you go back 3-4 years, right, say the NAV financing market was far less developed than it is right now. We've seen a lot more banks enter this market, trying to get into this market. They've seen the spreads are attractive, the structures are attractive. We certainly feel the same way. That's why we lend in this market as well, to everything from PE secondaries funds to VC funds as well as credit funds. So we really like the structural protections here, the low LTVs, and the requirements of cash sweeps if those LTVs are tripped, as well as actual pay downs if they continue to be tripped. So we think it's an attractive asset class. We can get it investment grade rated, which is nice for a lot of our capital. We'll continue to play in that space.
Good, thank you. Just switching gears on other, I would say, corner of the market. Clearly, I mean, the reg cap market, and definitely we'll see more coming to the market, specifically in Europe, and given the regulation, we see actually it's publicly as well announced in Canada. The banks are effectively being more constrained, so they will use certainly that as a way to raise capital. Is it a corner of the market that you're looking at, that you will potentially invest in? Achim, question for you. Or
so I don't think so. We are normally a plain vanilla investor, and as of course it takes some time to go through the new product process, and really need to have a fine, well-defined product that does not interfere with other products. We are sticking to those plain vanilla deals, and when we decide to go into the sub-asset class, then it's for years. And it's not that we see an opportunity exactly in that market and are able to then raise all the capacity in, 3 months' time and then invest into it. So what we need is to have a stable product, a stable asset class that really prevails over the cycle. Insofar, we are depending then on solutions, on originating products that cater for the special situation then the market may be in.
Frederic, maybe in your CLO platform, you'll be exposed to equity of that. It's not exactly a recap transaction for many reasons, but is it something that you would look at potentially as well going forward, or this is not very much part of the strategy either?
It's not really what we want.
You will not look at it. And you guys, I know that you do. Is it something that you see more and more as well in Europe? You see more as well in Canada developing, because we see very much far more interest from a lot of investors that are morphing actually from CLO equity investors to reg cap transaction across the world, where I would say the regulation, I would say, makes it interesting for those issuers. Is it something that you will keep developing on, or how do you see this market? Eli?
Sure. So look, it's a format of risk, right? So the way we've set up our business is to make sure we're capturing the entire asset-backed universe. One of the formats in which we capture it can be significant risk transfer. We very purposely not set up our business to be format specialists, where people run their business and say, we do CMBS, or we do SRT, or we do rated ABS transactions. We think that's very dangerous, especially in the asset-backed space. So we've purposely covered the entire universe. Now look, we have this quarterly newsletter. A couple of quarters ago, we wrote about this metric for a bank's balance sheet called AOCI. So AOCI shows non-mark-to-market losses on banks' balance sheets. So if you're a bank in the US and you hold a mortgage originated at 3% fix and you hold it to maturity, you don't expect to take a loss. And if you're holding that to distribute, you don't have to filter the losses all the way through to the bottom of your balance sheet. But those losses nevertheless still exist. And in a high-rate environment, as if you ever face a scenario where your deposits are maybe moving to one of the money center banks, and perhaps you're a regional bank, and your deposits aren't as sticky as you thought, you may be finding yourself in a situation where you have to sell those assets or find sources of liquidity. One of the ways you may find that liquidity is selling portfolios. Another one is an SRT or a risk transfer trade or a synthetic securitization or any number of other formats. And that is a very sensible way to buy risk that you really like. That's very different from saying, give me all the stuff in that format, because a lot of it is blind pool and has future originations in there, and we're generally institutionally quite allergic to that. But we certainly like, let's say, certain types of auto loans, and we're quite happy to access those auto loans in an SRT or other formats or an ABS format. So I'd say there is more of that around. There is certainly a much more relevant conversation to be had with a lot of banks who need capital relief or balance sheet relief. And that is often in SRT format, but we're not kind of married to the construct.
Thank you very much. I will want to touch on a very important as well theme, which is ESG, because obviously, and I wanted to ask a question before on SRT, just as well to point out the difference of strategies in this market, and ESG is the same thing. I mean, depending on the investors in a fund, Europe has obviously, and as a bank, we have this topic very much at heart. Europe investors, it's for most of them, it's a must. In the US, it's a slightly different approach. So I will want to hear your view around ESG, the fund that you want to create, and maybe starting with you, Frederic. How do you see this theme? And I think it's going to be a good after segue because there is a panel dedicated to that for real assets. So we want to hear that through the alternative credit prism.
It's a bit of a change in the way we see at MV, we see the world in which we want to live in. We started 23 years ago as an ethical fund where the word ESG didn't exist in terms of diversity, in terms of the type of investment we wanted to do. We were very focused on certain things. We were very clear. We wanted to make profit for investors in a certain way. We've never been however you want to call it, a impact fund or anything like that. More recently, we've adapted all of our, absolutely everything, to formalize what we've been doing for years. Again, in terms of diversity, about an integration of ESG process within your investment strategies everywhere. Now, at MV, all of our strategies, all of our 14 funds, have ESG rating by third parties. So this is part of our DNA. And now we want to go beyond that. We think it's not enough. We think it's a one-way street, whether you like it or not. And there's probably some major difference that we're now seeing emerging between the US and Europe, I believe. But for us, it's a one-way street. We are not going to react to regulation. We want to go beyond. We want to do the certain things. I'm sorry to say, but I'm going to be a bit controversial here, but we need to...
Go for it.
We've decided 15 years ago we didn't want to finance nursing homes and nurseries. We didn't want to make profit out of vulnerable people. This was a strong statement out of us. We knew that the only way to make profit out of nursing home was to decrease the level of service. And we want to demonstrate to many people that it goes beyond our little world. I want to demonstrate, we want to demonstrate that we can be capitalist, liberal, and actually do good things and be ethical. So for us, the next step is definitely impact and temperature, and decarbonizations are the next big objectives in our strategies.
Thank you, very, very clear and very inspiring, I would say. Achim, your strategy and the view around ESG as investor?
Yeah, well, as ESG is becoming more and more important for us, we became member of the Net Zero Asset Owner Alliance in spring this year. Insofar, we stick to goals to reduce CO2 footprint by 2025 and then 2030, 2040 and so on by those respective levels. And it will be difficult to achieve those things, of course, but we are doing good, and we are really finding solutions in order to do so. And to be frank, for some asset classes, it's easier to do so. So when it comes to equities and listed bonds and so on, you already have those measurements and the other things. For private debt, that is much more complicated, and there's still no market standard to find that, as it is for ESG in general. There's no market standard. There are some companies providing ESG ratings and so on, but some more guidance would be helpful there in order to really have a market-wide standard where people can stick to, and it's no question that we all have to stick to that, and in order to reduce climate or to keep climate change as low as possible.
Thank you. And maybe I would like your view, and to both of you, but maybe Darren, just given the funds, you've got the global funds, Ares, Pimco, and the investors, depending on where they are, definitely will have a different view. So how do you reconcile the different views, I would say, of the world, and mostly US, Europe, and then after the rest of the world, where it's slightly, it depends on I would say, on the region.
Yeah, sure. So a lot of it is taking the lead from our investors, right, and what they're looking for. To your point, obviously in separate account type format, that's reasonably easy. We can tailor the investment guidelines to whatever they want from an ESG standpoint. Commingled funds is a little more challenging, but we have carve-outs in our funds that if an investor comes into the fund and says, I can't do gaming or I can't do defense, we can carve that investor out of those investments, so their capital is not directed towards those investments. Every IC memo now that is presented to our investment committees, there's an analysis in there about the ESG impact of that investment, positive or negative. So it's something that we consider in all the deals that we're doing.
Thank you very much. Eli, maybe one point?
Sure. So I want to echo, of course, we have a robust ESG policy, and I think most major asset managers at this point do, and some of our partners across the Ares platform have done sustainability-linked loans, so it's a big part of the Ares DNA. In alternative credit, what we've done is we've decided that the best way we can make an impact is actually to ensure that our flagship funds, called both Pathfinder and Pathfinder Core, have a charitable tie-in, which comes from our carry. So both the team and Ares contribute a share of the carry pool from both funds to a charitable trust for global health and education. Well, we're pretty good at investing, we think. We may not be the best people to allocate impact dollars, so we think the best way to do that is to actually allocate some of the profits towards impact. So we hope that that's sort of a theme that spreads, so please tell your friends and competitors, and hopefully they'll take up the mantle as well.
Thank you very much. I think we reached the end of the panel. I think we'll leave like 5 minutes, maybe over time, but not too much.
You are actually
If you have any questions,
time.
Christina,
well, thank you very much. I think we can give you a great round of applause.